Good afternoon or morning, depending on where you're calling from. My name is David Starkey, and I'm one of Cambridge's market analysts. Thank you for taking the time to join us in our review of how the UK's decision to exit the EU is expected to impact currencies over the next 6 months. As it stands, and in the short term, it looks like economic consequences of the Brexit vote will, for the most part, be contained to the United Kingdom. Early indications point to a dramatic downturn in confidence in Britain as economic and political uncertainty constrains the outlook. This in turn looks like it will lead to sharp reductions in spending and consumption on the part of both businesses and households. Virtually all banks and economic forecasters, along with the Bank of England, have suggested that this will likely result in the UK entering recession during 2017, which will be followed by an extended period of stagnated growth. Internationally, however, only an incremental, not systemic uptick in risk is expected. Analysis of data shows that Britain's overall contribution to global economic growth is minimal. Furthermore, the asymmetric nature of trade between the UK and the rest of the EU, specifically the Eurozone, implies limited broader economic instability in the region in the near term. In fact, for the moment, predominantly the risks for the EU are longer term and political in nature. Additionally, many non-UK measures of risk have for the most part already rebounded to pre-referendum levels following brief spikes in the days immediately following June 23rd. As such, global financial crisis or Greek debt crisis-esque scenarios seem unlikely at this time. From a currency perspective, going forward, domestic data and policy is expected to weigh on the pound. Thus, despite the dramatic sell-off in sterling experienced immediately following the referendum, further weakness and a continuation of elevated volatility is expected, though with a somewhat shallower overall trajectory than in the last month. Beyond the pound, however, Brexit has not dramatically altered the base outlook. Changes are, as mentioned above, only incremental and not systemic in nature. Our analysis will start with an impact assessment of the initial post-Brexit period, which will remain predominantly UK-focused, after which we'll review Cambridge's base case for the political and economic landscape from now going into 2017. We shall avoid too much speculation of what the so-called Brexit deal might look like, since it's not specifically relevant to the time period under analysis. In line with guidance from the new administration, Cambridge doesn't expect Article 50 to be triggered until at least the tail end of 2016 and perhaps early 2017. However, at that time, financial market volatility is expected to increase commensurate with political rhetoric, and the net effect of which will determine the economic landscape. The analysis will be followed by a brief summary of the UK's global position and, on a targeted basis, what the likely spillover risks are and are not given our time horizon for the euro, the American dollar, and other blocks of currencies. On the political side, predictably, the shock Brexit result has led to a substantial shakeup. Despite victory, the Leave campaign seemed to be without strategy for how to proceed after June 23rd. Political infighting and uncertainty have been the hallmarks of the immediate post-referendum period. However, all of that said, a sense of direction does look to be returning ahead of schedule, now that Theresa May has been confirmed as the UK's new Prime Minister. This looks to have saved financial markets months of potential uncertainty, as the leadership race was originally slated to conclude in September. In the hours following defeat, key government Remain campaigners, including now ex-Prime Minister David Cameron and ex-Chancellor of the Exchequer George Osborne, were quick to step aside, as would be expected. This triggered a leadership race. Shockingly, however, by their own hand or by being politically outmaneuvered, the two most prominent government Brexit campaigners, Michael Gove and Boris Johnson, will have no direct involvement in Britain's negotiation of an exit from the EU. The job of Brexit czar being handed to veteran policymaker David Davis by the new Prime Minister, of whom it must be said ironically came down on the Remain side of the fence. In fact, during the peak of the power vacuum, calm came from an unlikely source. The apolitical governor of the Bank of England, Mark Carney. Carney provided the most stability and semblance of a plan in the days that immediately followed June 23rd. He confirmed to financial markets and the general public that the Bank of England has the tools and that the financial system is robust enough to combat expected economic uncertainty. On the economic side, the immediate aftermath of the surprise referendum result has largely mirrored the tail risks outlined in advance by the Bank of England as well as many other banks and forecasters. Uncertainty has seen consumer and business sentiment sour. Official economic indicators for the post-Brexit period haven't been published yet. However, given uncertainty, downward pre-referendum trends in leading indicators like the Purchasing Managers Index are expected to continue. While official data is playing catch-up, post-Brexit, privately commissioned surveys are available and have not been encouraging. Deloitte recently published surveys from a comprehensive corporate survey, highlights from which include a staggering 82% of UK CFOs expecting to cut capital expenditure. Meanwhile, 83% expected to pay the pace of hiring to trim. Furthermore, revelations of a Brexit have pushed volatility in domestic financial markets back up towards global financial crisis and Greek debt crisis levels. Sterling, as mentioned before, experienced a swift and historic sell-off to the tune of about 10%. Gilt yields have contracted to record lows as markets price in more accommodative monetary policy. However, investment-grade corporate bonds yields have decreased by a lesser proportion, indicating that credit spreads in the UK are in fact widening. Interestingly, the expectation of looser monetary policy has for the moment largely spared the British stock market. The FTSE 100 has in fact bounced back and is trading near its highest level in a year after an initial sell-off in the days following June 23rd. Domestically in the UK, consequences of a Brexit are likely to be significant and long-lasting in ways financial markets don't fully yet comprehend and can't quantify. That said, the local financial system is robust, and global financial crisis-era policies are positioned well to support the economy through near-term uncertainty. Additionally, and regardless of the inevitable uncertainty that goes along with negotiations, for at least the next 2 years, the UK will maintain unfettered access to the single market. As such, economic operations over that period from a theoretical basis should continue unencumbered near the status quo. Unlike the global financial crisis, risks aren't born from the financial system. Rather, it's a tool to help defend the UK's interests. Instead, threats over the 6-month analysis period stem from elsewhere in the economy. In the short term, the main risk factors can be categorized as a function of uncertainty on either funding the UK's extreme current account deficit and/or subdued domestic spending. As it stands, the UK's current account deficit sits at 5.74% of GDP, its most extreme level since modern records began in the post-war period. Meanwhile, by comparison, the USA's current account deficit sits at 2.65%, and the EU maintains a current account surplus of 3.75%. The high current account deficit in the UK is a specific concern in the context of a Brexit, since over 50% of UK FDI, foreign direct investment, is sourced from the EU. And furthermore, anecdotal evidence suggests that a material proportion of portfolio investment capital that lands in Britain is a function of investors seeking European exposure via the UK's more favorable corporate tax regime. Uncertainty from a Brexit fundamentally threatens both channels. Specifically singled out by the Bank of England as at risk is the UK's commercial real estate market, which according to data compiled by the Bank of England is about 45% foreign direct investment. Alarmingly, in Q1 of 2016, FDI inflows into commercial real estate declined by 50%, a trend widely expected to continue while economic uncertainty persists. Turning to domestic spending, concerns exist on both a household and corporate level. On the part of businesses, economic uncertainty tends to result in slower hiring and reduced capital expenditure. Meanwhile, from a household perspective, perceived lowered job security naturally breeds concerns about future disposable income. This in turn leads to elevated savings and reduced consumption. Data showed that output growth in the UK slowed in Q1 of 2016 at the mere threat of a Brexit. Signals from the labour market and sentiment indicators suggest that Q2 data published at the end of July will reflect further deterioration pre-Brexit. It's Cambridge's view that the Brexit-related declines in foreign direct investment, as well as portfolio inflows alongside reductions in corporate and household spending, will amplify the trend in slowing GDP growth observed in the first half of 2016. Ultimately, the materially diminished output growth over our analysis period is expected to result in the UK entering a short recession during 2017, which will be followed by a period of stagnated growth as the shock period works its way through the economic calculations. Growth of a shallow trajectory being a product of two elements. One, the UK's continued access to the single market for at least 2 years after Article 50 is triggered. And two, expected accommodative monetary stimulus helping to offset ongoing uncertainty associated with the exercise of negotiating a Brexit, much in the way similar stimulus aided the British economy through the navigation of the global financial crisis. Specifically, and in line with broader sentiment, Cambridge expects the Bank of England to roll out a program of stimulus on August 4th at its quarterly inflation report. This program is expected to include a 0.25% rate cut to the benchmark interest rate, and possibly an expansion to the existing £375 billion quantitative easing program. The referendum result crystallizes arguably the largest tail risk in currency markets for 2016. Economic and political uncertainty that it entails has triggered a structural downshift in the value of the British pound. The confirmation of Theresa May as Prime Minister seems to have marked the end of currency markets' knee-jerk reaction to the Brexit. However, broad sentiment remains firmly to the downside. Additionally, unprecedented levels of uncertainty are likely to cause volatility to remain at or near current elevated levels. As it stands, money markets only have an 84% chance of a rate cut priced in for the August quarterly inflation report. Assuming Cambridge's base case easing on August 4th, this suggests that there is downside still in the GBP through the immediate term. Furthermore, beyond the quarterly inflation report, we expect the Bank of England to remain somewhat more proactive on the policy front than it has in the last few years, including sporadic rate cuts of 0.05 or 0.10%, alongside targeted expansions and extensions to the quantitative easing program, similar to the European Central Bank over the last 12 months. Shifting from policy to data, as outlined earlier, forecasts for sliding economic fundamentals over our analysis period. These expectations and the monetary policy accommodation that goes with it is expected to pose an ongoing threat to the British pound, and Cambridge finds little reason to expect any kind of meaningful correction higher. Rather, trading in sterling pairs is likely to remain choppy with an overall downward trajectory. While an important member of the EU, Britain's global importance and thus possible impact is limited in scale when a Brexit is considered. According to the IMF, in 2015, the UK's share of world GDP was relatively small at around 4%, and it accounted for what amounts to a rounding error's contribution in GDP growth at 0.01%. In comparison, the USA accounts for 25% of world GDP and about 25% of GDP growth. While the European Union accounts for 22% of world GDP, the UK does not participate in the single currency, meaning its departure from the EU doesn't necessitate the same kind of existential questions that a Brexit might entail. In fact, there's precedence in Norway for an orderly British exit from the core of the EU, while at the same time maintaining preferential access to the single market key to its economy. While British barometers for risk like volatility in GBP and credit spreads are fragile post-referendum, non-UK measures are encouraging. Global equity markets have rebounded after initial sell-offs. The VIX has dropped to its lowest level in a year, and credit spreads in the United States have narrowed after an initial widening. Additionally, in Europe, spreads over bonds are back near pre-June 23rd levels for the most part. Thus, in considering the UK's global relevance and the rebound in traditional non-UK risk measures, global financial crisis or Greek debt crisis levels of turmoil over the analysis period are unlikely. Rather, the referendum result has led to an incremental uptick in global risk, not systemic. There is no doubt, given close relations, the implications for Brexit on the EU. Substantial and far-reaching, both on a political and economic scale. However, over the analysis period, Brexit warrants adjustments to the existing outlook, not a dramatic overhaul at this stage. From a political standpoint, in the short term, it seems turbulence experienced in the UK over the month that followed the result has tempered a dramatic rise in nationalist sentiment that many banks had forecasted across the EU. Furthermore, uncertainty surrounding actual negotiations of a Brexit have slipped out of the spotlight for the moment, as British politicians don't seem in any rush to trigger Article 50. As such, tail risks exist, but for the moment remain peripheral. From an economic perspective, asymmetric trade linkages between the EU and Britain further diminish the risk of a systemic collapse in the EU over the analysis period. According to Moody's, while 45 to 50% of UK exports go to the EU, only about 7% of EU exports go to the UK. As such, economic risk is manageable in most circumstances, albeit skewed towards those countries with higher degrees of tourism and/or supply chain exposure to the UK. Moody's singled out Ireland and the Netherlands as relatively more vulnerable than countries like Germany and France. Cambridge's base case scenario calls for a modest increase in downward pressure on CPI as the Eurozone imports deflation from the UK via the sell-off in the British pound. It also expects additional pressure on targeted parts of the labor sector, like tourism and related industries. As well, GDP growth is likely to stagnate further as investments in both directions are trimmed back. In consideration of the economic risks, we continue to expect further accommodation from the ECB before the end of 2016, as was the case pre-June 23rd. In light of the incremental nature of short-term changes to the outlook, broadly speaking, euro trading is likely to continue as it was pre-Brexit, with only a cautionary nod to the Brexit added in the short term. The only dramatic change to forecast is the channel pair. Cambridge's view is that material domestic weakness in the UK and expectations for fresh policy accommodation from the Bank of England have reset the equilibrium value for sterling euro. However, economic weakness and uncertainty in the UK is offset by that of the Eurozone. While volatility is expected to remain elevated, the overall trajectory is expected to be mostly flat in the new post-Brexit levels around 118 over the forecast period. The UK accounts for less than 5% of US exports, which equates to only about 0.04% of overall GDP. Once again, the spillover effects of Brexit on the United States in all but the most extreme scenarios appears manageable. As such, Cambridge's base scenario doesn't see any material adjustments to the underlying fundamental economic performance in the USA over the forecast period. Turning to policy, Brexit affords the Federal Reserve latitude to wait and see for a couple of months, but little more. The occasional wobble, like May's non-farm payroll result aside, as it stands, the American economic recovery appears to be on track. This weakens the argument for the necessity of current crisis-era policies. Cambridge continues to see a single rate hike in late 2016 in line with a policy of cautiously and gradually weaning financial markets off of global financial crisis-era stimulus. Weakness and uncertainty in the UK against the backdrop of a budding recovery in the United States puts cable on a volatile downward path. Cambridge sees sterling dollar trading as low as 125 over the forecast period, with spikes in volatility surrounding events like August Bank of England quarterly inflation report and late 2016 Fed policy updates in anticipation of a rate hike. Looking beyond performance of sterling, Cambridge continues to expect the American dollar to outperform the euro given contrasting monetary policy outlooks. With that in mind, look for euro dollar to retest multi-year lows near 105 in the second half of 2016. As covered already, given the UK's minimal contribution to global GDP outside of performance versus the Great British Pound, no meaningful changes have been made for the outlook of Australian dollar, Canadian dollar, and New Zealand dollar over the forecast period. Specifically, Cambridge expects weakness versus the greenback in the context of the American economic rebound and outlook for tighter monetary policy. In terms of sterling's overall performance versus the bloc, volatility is expected to remain elevated with an overall shallow trajectory to the downside from new post-Brexit levels over the forecast period. The key driver being the uncertain British landscape. From a relative perspective, the Canadian dollar is positioned to perform most strongly against the sterling over the forecast period. A rebound in crude prices from early 2016 lows and the spillover effects of an economic recovery in the U.S. offer a base from which CAD can appreciate against sterling. Given that sentiment plays such an important role in the value of the Japanese yen and Swiss franc, the potential for broader impact of the Brexit on this group is higher in the long run, especially when political tail risks are considered. Thus, in the case of sterling, safe havens are now expected to, a greater extent, outperform over the analysis period. However, as highlighted earlier, non-British risk barometers have largely returned to pre-June 23rd levels. Accordingly, changes are modest. Overall, Swiss franc will continue to be trading will be derived from its trading against the euro and related factors. The macro and political outlook suggests that euro-Swiss franc is likely to continue trading sub 110. However, expect the Swiss National Bank to prop the pair up anytime it dips too quickly. It was recently revealed that during the volatility immediately following Britain's EU membership referendum, intervention in the currency markets took place around the 106 area. Despite substantial monetary policy stimulus, the Japanese yen has appreciated broadly in the first half of 2016, as risk aversion related to slower global growth, particularly in regards to China, generated yen interest. While broader global growth concerns have for the moment leveled out somewhat, the addition of Brexit-related uncertainty supports the notion for ongoing yen strength, albeit at a less steep pace as seen in the first half of the year. Specifically, there's still downside room in US JPY down towards 100 in the months ahead. However, growing expectations of a hawkish Fed at the end of the year imply both a reversal in risk sentiment and yen going into 2017. Thank you all for listening. I'll now open the floor up to questions.